Welcome to Garris Horn Insights. I'm Ray Sneishovel, partner at Garris Horn, and today we have managing partner Troy Garris to talk about loan compensation rule. Look, I know we talk about loan comp many ways in this industry, but I think there's some really key poignant issues that Troy wants to bring up and discuss that we're kind of seeing frequently and most recently in some of the things we're dealing with. So I thought it would be a good topic to bring up loan comp again. Thank you, Troy, for coming on to the podcast.
Yeah, thank you, Ray. Thanks for doing this as always, and thanks to everybody who's watching this wherever you may be and whatever platform you may be on. So we'll make this pretty quick, really. But as we go into the end of the year, I thought it might make sense when people start thinking about bonuses, when people start thinking about how people are getting paid, when people start thinking about what a Trump administration might look like. I think that it's important to remember a few things about LO compensation rules that are important when you're paying somebody who is covered by them. So somebody like a producing branch manager or somebody like a loan officer or somebody even like a broker. I think that that's important to keep these things in mind. And also, if there are weaknesses in your particular program, like if you have agreements that are not ideal the way you want them, or you have a structure that you think may be a little risky or may not be in the marketplace, now is a good time to think about any sort of revisions to that, because January 1st is a good time, a good excuse, so to speak, to make sure that you're refreshed and start the year off right.
Very good. Well, thanks, Troy. So why don't you hit off on your first point on loan comp? What's on your mind?
Yeah, so I think I can boil it down to four simple categories. So first one is, this is a hot button issue for regulators right now, and it is loan originators paying concessions. So as everybody probably knows, loan originators cannot be made to pay concessions. So the customer comes in and says, hey, I want a discount, I want lower fees, I want a better rate, whatever that might be, however it looks like for the particular transaction. Loan originators frequently are willing to say, hey, I tell you what, how about you just take it out of my pay? I'll get the deal done, and I'm fine with that. The problem is the LO comp rule does not allow that. And the CFPB has made clear that both in the rule itself and then in the commentary also, and in public comments for the longest of times, the CFPB has said that loan originators can't pay for concessions. Concessions are fine. They just got to be in the form of things like lender credits. The lender can bear the cost of the concessions. The LOs can't.
And I think, though, that, I think you are correct. There is a challenge there that you can do certain things with compensation, the loan officer's compensation, in an unforeseen circumstance. But
That's
I would imagine the unforeseen circumstance is a very high threshold. It really has to be unforeseen. And I would think then you would hardly or rarely apply it. Does that make sense?
It does. And in fact, there is some specific language in the rule that says in those unforeseen circumstances that you can have the LO. Now, you got to have it in their agreement, but the LO can agree to pay for those whatever the costs are of those unforeseen events. But it's things like the LO comp rule itself uses examples like the title agency or the closing escrow company makes a mistake, and because of the delay there that is completely outside the LO's or the lender's control, because of that mistake, there's a delay, you bust through a lock period, there's a lock fee, and so the LO can agree, hey, I'll pay that lock fee for this unforeseen event that has occurred on this particular transaction. That doesn't mean that they can pay all the fees. That doesn't mean they can pay all the any concessions that were made. But for that lock fee, that was an unforeseen expense, they can make that payment. Again, if it's in their agreement. If it's not in the agreement, they can't do that anyways.
Very good. All right.
So I think, yeah. Well, I think those instances, just like you said, Ray, were they're pretty minor and pretty rare as a general circumstance. And I think that most companies don't even put that in their agreements. It's something you might consider, but most people don't even put in their agreements because it is so rare.
Yeah, I think the one way, because clients will ask, how do we know unforeseen, and what about this situation? So look, at the end of the day, if you look and there's a pattern of practice in which you're making concessions on, I'm going to make an example, 40% of the loans. Well, that's not unforeseen, right? That's a practice. So unforeseen really is a small percentage, not very frequently hit, and very specific, fact specific issues that will show that there was no way you could have known. It's about knowing or could have known. Like, no, it was, as you said, the closing agent error was not even conceived. I'm not even saying that's unforeseeable, but that's at least an element that I couldn't even control at that point. I wouldn't know. So I agree with you. I think we'll see what happens on that. But that is one point people like to work with, but I think they have to be very cautious.
Yeah, I think that's right. And sort of related to that, the second point I was going to bring up is there is this notion in the marketplace that one way to sort of get around the general prohibition on changing of or having the LOs pay for concessions is the ability to change the category of the transaction. So I'll just set up a simple example. There are dozens of these types of examples probably, but let's say a company has a loan, a self-generated loan category at which the LO gets paid one amount. Let's call it 100 bips just for simplicity. So you get paid 100 bips for a self-generated loan, a lead that you brought in, and you get paid a different amount, usually lower, for a company-generated lead. So let's say the company has some relationship with some builder, some realtor, something like that, and so they bring in leads. Maybe they buy lending tree leads, something like that. And so they just hand those leads to the loan originator, and they say, hey, go out and call this person. They want a loan. And so they usually pay less for that. Maybe let's just, in the example, call it 50 bips. So 100 bips for self-gen, 50 bips for company gen. And then the LO is talking to a consumer, and the consumer says, hey, I want a discount. The LO says, I really can't give any discounts. I'm all out of discounts. My company only gives me so many per month, let's say. I just can't do that. But the LO says, and sometimes they figure out a way to do this, they say, but if you, instead of applying with me directly like you're trying to do right now, if you go around and go through this other channel, I can get you into this other method of applying, and I'll just tell them, hey, I know this person, that should come to me, and then I'll be able to get paid on the company-generated lead channel, and by doing that, I'll get paid less, and so hopefully they'll be more likely to give you a discount. I think that not a lot of companies really have programs set up the way that they intend to do that, but I think that there are some number of LOs that have figured out ways to kind of game that system a little bit. And so companies need to be really vigilant, because if the CFPB were to, just based on my very simplistic example, CFPB were to find that, or a state regulator find that, they could very well say, well, what you're doing is you're setting up a system that's too lightly controlled, and so your LOs are abusing it. I think that's
let me bring up a point, though, both in that one and the other. But, isn't it true that, it's improving it for the borrower and the consumer experience, therefore it's legal? Isn't that a good defense?
So that's a great defense from the position of this is the way it should be.
Yeah.
But it's not the way that it is. The rules just don't allow it. And so if the agency and if the Congress were to make changes, maybe they would. And, the MBA, the National MBA, has for a long time been asking for some relief in this regard. So if there were changes to be made, I think this might be one of those areas where it would be a good idea for the agency to come around and say, we should think through this a little more closely. But currently, it's not allowed, even if it's in the benefit of the borrower.
Exactly.
Yeah.
All right. What other point? What you got on loan comp otherwise? What's your next point?
Yeah. So another area is just kind of things that I see out in the world where people are kind of ignoring the rules. And I think it's in part because of this very tough market we're in. And so people are trying to find ways where they are just running roughshod in some ways over what usually have been viewed as the requirements. And there is a lot of area of the LO comp rule where there's gray and people don't really know what the rules are. And even if they think they know what the rules are, the rules might be a little different. And so I think there are a lot of areas where people are just sort of doing that sort of thing. So, for example, there's some sort of murky language that came out of the CFPB's summary of exams that they put out periodically. This has been out about a year and a half now, but there was language in the summary highlights that suggested you can't pay differently for brokered transactions versus in-house transactions. If you read the language closely, it doesn't exactly say much of anything. It's kind of twisted and it seems to use an example that doesn't fit for a lot of people. But I do think that the CFPB is out there, and I think the states are kind of following along now, that they are thinking, well, a system where you're paying differently brokered in versus in-house, I think that's not going to fly probably, even though, again, I can make some good arguments that it's perfectly fine. It's not impermissible.
I agree. I think it's going to be facts and circumstances, right? We don't know. I know what you're talking about in the highlights, and there wasn't really a lot of detail about the facts and circumstances. For example, were they brokering out a different loan product and being paid different than if they were keeping it in-house? And now it becomes a product issue. And in terms of the transaction, it goes to the core of what loan comp is. Was that what it was about? And it happened to be brokered out versus wholesale, or brokered out versus keeping it internal? Or was it just the fact that it was brokered out versus kept internal in and of itself was a problem? And I don't think it was pretty clear.
Yeah, it's a great finesse. So the way that they seem to talk about it was that they paid one amount for in-house products that were forward mortgages, and they paid a different amount for reverse mortgages, and they brokered those out. Now that was just a little statement in this blurb, a couple sentences. That's it. That's all the detail that you get. But it raises a lot of questions. So, for example, reverse mortgages almost exclusively, there's a small pool that's a small percentage that's not true for, but almost exclusively not even covered by the LO comp rule because they're open-end mortgages. So there's the question of, are they trying to signal whether CFPB is trying to signal that in fact paying differently for open-end versus closed-end is somehow a problem? I've never heard the CFPB take that position. I don't think that's the position the CFPB probably would take, but it raises that question. Also, was it just that product? And were the people, did they have just one product that they paid differently on, or was it all brokered transactions? Which could be for very different types of reasons, including it could be that you just have you're tapped out on your warehouse line, and so you need to be able to broker out transactions because your warehouse capacity is at its end. So you just run out of space on your line, and so there could be a lot of different reasons. But what seems to be the case, I think, is that CFPB is signaling it's mainly if you're paying differently based on a product, which they have said is not permitted, that it would be a problem. I still think there's a lot of ability to make arguments there, but I do think that's one of those areas that people are seeming to ignore a little bit. Another area I think that you've probably seen a lot of this too is people paying licensed real estate agents and brokers to be loan officers as well. And so I think that there are a lot of people that are doing that in kind of a sloppy format. And so people want to make sure that if they're going to have a program like that, they really think through the various issues, including LO compensation. There's other issues too, RESPA, licensing. There's all these other issues that go along with that also. But I think LO comp is certainly one of those. I think another area that people are really getting hung up on and people have been talking about and LOs as they get recruited are focusing on, and this is not really LO comp specific really, but but it kind of is, and it deals with 1099 versus W-2 loan originators, and the way that it deals with the way that it comes up in the LO comp context is that if a person is a contractor, a 1099 in other words, then there's a pretty good argument that that person is essentially a broker to the company that's making the loan. Now, the LO comp rule is a little sloppy in the way that it talks about loan originators, talks about them as employees, as contractors. And so there's a lot of unknown there, but it's certainly an area that people should be aware of. And I will say, just my footnote, as always, on these 1099 versus W-2 conversations, I don't think the 1099 argument is a very good argument. I think that, there are a lot of ways that people can, regulators, whether it's a mortgage banking regulator, whether it's the Department of Labor, whether it's a taxing authority, either federal or state, I think there's a lot of risk in that 1099 structure. People got to be careful about.
Yeah, I think what happens is I think it's death by a thousand cuts. So it's one issue doesn't look good, and then couple it with the rest of the issue, and then you start layering, right? Some
Right.
of these issues. I'm not saying everything's not legal or what is legal. As you know, these aren't legal opinions anyway we're given here, but it's something to think about. And once you start layering, it's harder to get out of to explain what you're doing. I think the more complicated it gets, the harder it is to explain yourself out of it. And so you might get a good argument just on the 1099 and great, but when you couple it with, and it's a real estate agent and this is what they're doing and they're doing a referral and don't forget about this, and are they really an employee and did we have any labor law issues? Those are the things that kind of kick in. So not saying not to do it, but you really have to explore it very carefully. I agree with you. So, well, good. I appreciate it.
So what do you think about the new administration coming in and its effect, if any, on the CFPB and on LO comp specifically?
Well, interesting. We can speak hours on that, of course, and most of it's going to be speculation because we don't really know. The signaling we're getting, of course, is that right now it's the CFPB shouldn't even exist, and that's kind of the message that's coming out. The reality is, I suppose, is since the CFPB is a congressional order, not an agency in and of itself spun from the administration or the executive level, I don't think you can just outright delete the CFPB. I also think that there's a lot of complexities in Dodd-Frank that have to still apply and not apply. It's not that simple, but I do think it signals that the approach might be a little bit different on some of these things, whether it's going to be enforcement or explanation or application of rules. Is there room for improvement if we're talking about a balanced approach for CFPB? In my personal opinion, yes, I think there's room. So I think it'll be interesting to see if maybe we get back to an era where our regulator is a partner in this and will help us navigate some of the complex issues so that we can all benefit or result. So the result will be that it benefits the consumer, actually. Is the loan comp one of the issues that maybe would be a good, in the crosshairs for clarity? I think so. When we talk about, as we said earlier, the consumer experience isn't enhanced because of the loan comp rule. There is in one way, but not others. So oddly enough. So I think maybe there's room there. What do you think? What do you think, Troy?
I think it's going down with Doge. Nah, it's fun to talk about, that sort of broad sweeping kind of change. That when Dodd-Frank came in, that was one of those broad sweeping changes, right? And I think the people have sort of figured out over the course of time that when you make such a massive change in a system, there are lots of unintended consequences.
Correct.
And I think that would be true if they were to just delete the CFPB too. It doesn't mean that there shouldn't be massive changes to the way the CFPB operates. There should, in my view.
Agreed.
There's a lot of things that the CFPB does and has done for now, 10 plus years, that just is not the way the world is supposed to work in a democracy where Congress is writing the laws and the executive is enforcing the laws that Congress writes. This is not what the CFPB is, and I think there could be a lot of ways that it could be made better, and could actually help in much better ways than it currently does or has historically done. And I don't think, the way the laws are set up, and Dodd-Frank is massive, right? The way the laws are set up, they're so entangled with other different components that it would be, I think, a monumental task to try to get rid of even just the CFPB. Dodd-Frank is much bigger than just CFPB, but even just CFPB, I think would be a big hurdle. Not to say it can't be done. There's some chance, but the margin in the House, the margin in the Senate is relatively small, and I think there would be a pretty big uphill push. Not to mention they have a lot of things going on. They have, there are lots of agencies that are not liked by lots of people, but also have their friends in various places too, various constituencies. Yeah.
But you bring up a good point. Is so let's pull it together, right? It's like, so we talk about the loan comp rule. We talked about that the loan comp rule sometimes loses sight on consumer centricity and what's best for the consumer just by virtue of its application of the rule, right? And then we ask about, is there possible change in the future? And maybe the loan comp rule is the right thing to change, but let's not mix the two up, right? In the meantime, the rule of law is the loan comp as follows and as issued by and is treated by the CFPB in the last few years. So, I wouldn't be going in 2025 and having the courage to change my comp plans with the expectation that it's going to be deleted.
Right.
We see opportunities that maybe we can get some clarity or changes where it makes sense for consumers as well as for the industry. But I wouldn't bank on that yet because we got to see how it turns out. So interesting perspective. I appreciate that. I appreciate the question. We'll see how it comes out.
And I'm hopeful that some positive things will come out of this. Really for the industry itself, the industry has been in a bit of doldrums for a couple of years now, and it really could use some fresh news, some good news in that regard. I will say too, though, that I see a lot of states now that are enforcing in ways that I think the states are believing that they're kind of stepping into the role of some of the federal regulators if the feds back off. And so I would anticipate that may increase as well.
I would completely agree with that. And that's my experience as well. So absolutely. Well, thanks for the conversation on loan comp and loan comp plus, right, in this conversation, but on loan compensation rule. If everybody has any questions, you know how to reach us, and we surely know how to reach Troy Garris. And so far as any questions about loan compensation in your specific case, because I think, company, it's different. So these rules aren't absolute. There are a few of them, but how it applies in your shop, may differ. So it's always a fun conversation to have. So thanks, Troy, for your time, and thanks everyone for listening. Yeah, sure. Thanks everyone for listening, and hope to see you in our next episode of Garris Horn Insights.
Thanks, everybody. Take care.